Welcome everyone to Office Hours for Traders Post for April 5th, 2024. It's a beautiful Friday to be trading, just like every Friday is, and I'm very happy to be here with Mike Christensen, co-founder and CSO of Traders Post. How's it going, Mike?
Great, Tom. How are you today?
Pretty good, pretty good. I gotta say, the whenever the markets get to some sort of top and people come out of the woodwork saying, "Hey, we're about to fall 50%." I know it's like that sort of doomsday sort of conversation that happens around there.
hmm
In your experience, does it happen like every time the market makes a top?
Mm,
People call for some huge correction.
for sure. And then everybody wants to take credit when they're right, and then there's a whole group of people that are wrong. I think what's always interesting is when there's a consolidation zone of any kind. The more negative people get, sometimes the more bullish you should be, and the more positive they get, the more bearish you should be. It does seem like popular sentiment can sometimes send an inverse signal. But right now, this little sell-off yesterday could just be confirming support of a stronger support zone. So I'm not sure yet.
Sure. I mean, with liquidity the way that it is, let's see how it takes. Because we have the liquidity coming in from China printing, but it's not really helping their economy a huge amount. But maybe it's help the rest of the world. We're in uncharted territory here. It's pretty
I
cool.
think so. Yep.
All right. So as normal, we answer your questions week by week. How to use Traders Post better? How to become how to use our tool to become a better automated trader? We're here to make sure that our tool becomes the best platform for you to automate your trades with your broker. And so this week we have a series of questions that we've gotten from support tickets, from Discord, and from online, which we'll go through. But before that, I just wanted to point out something that happened that TradingView released recently, which is the volume charts, the new type of chart. What do you call this?
I guess it's a chart type.
Chart layout, right?
Yeah.
Chart type. There we go. And I thought it was pretty cool. Over here, if we take a look here, this is the volume candle option. And look at that. We got candles now that are weighted. The size of the candle, the width of the candle is weighted according to the amount of volume that happened there. Which, you know what? When you initially showed me this, Mike, I was sort of like, oh, I was poo-pooing it. I'm really liking it now. And I realized why I was upset. Because it makes one of my indicators that I created now obsolete, and I'm gonna have to like completely redo it.
Well, yeah, that's one reason not to like it. I think the things we noticed when we looked at it yesterday were it makes you feel a little drunk at first. You can't quite tell why there's this inconsistency in the candle size, so it's a little wonky to look at first. But I think the information that's there is useful. If you can, like Tom, if you can disable the volume at the bottom. I think now what we get here is basically this complete picture of what's happening with both price and volume in a more consolidated way. We get the wicks, we get our high and low, we get the size of the body of the candle, we get a sense of trend, and we get a sense of where buyers and sellers are showing up. Just a quick glance at just the candles alone here, we can see where those rejections are and where selling is confirmed and a new trend to the downside shows up. And I think that's a nice feature of the volume candles, is that if you're a day trader and you're staring at charts all day long, it's really easy to forget volume as an indicator. And it kind of gets tucked away at the bottom on a lot of people's charts, or they ignore it entirely. And so this is a nice way, I think, to tell the whole story of what's happening with trend with volume incorporated.
Yeah, to me, the beginning of everything. I mean, not just to me, but in general, that if often you'll look at a strategy that you're running, and then you'll only realize later on, oh right, I forgot to take a look at this metric. Oh right, if I had taken that into consideration, I wouldn't have been fooled by a particular type of move. And price, volume, and volatility are one of the three components that I think are at the top of the list of things to pay attention to. And so that's pretty cool to see.
For sure. Yeah, I think it's like it's a little bit about like photography. If you've ever studied the three types of light that are taken in by a camera, if you kind of forget ISO as a sensitivity on the sensor all the time, then your pictures can sometimes come out pretty grainy. And I think that's kind of the case here with trading, where if you're forgetting volume as sort of that third component, sometimes you can take trades that really don't get confirmed by the rest of the market.
Right. Perfect. All right, so I hope that right up there with I don't know if you use Renko charts or Heiken-Ashi charts or anything like that in order to assess our trend. Is that something that you use in your daily life?
Not daily. Heiken-Ashi is definitely something I studied for a while as part of the work that I've done, but it's never been as useful as I would have liked it to be. Still a classic candle chart kind of guy.
No problem. Old school. I like that.
Yeah.
All right. So the one of the first questions we have here comes from one of our clients. It says, "Is it possible to send a stop or trailing stop? Is it possible to send a stop or trailing stop only order by webhooks? Does it have to include buy or sell order?"
The answer is yes to the second question. It does have to include your buy or sell order, or your entry order, as we would call it. And this is more of a limitation of the brokers. The type of order, if they support brackets, is a bracket order, which would mean there you would specify your stop or your trailing stop. Unfortunately, it's not currently possible to send a trailing stop request after the fact, but it is something I think we can look into with certain brokers. But to send a stop limit order or a stop market order is certainly something you can do as a separate signal, but it would be sent through as a stop limit order would be the one option you have, or a take profit or a limit order. So the answer is no, not currently possible.
Understood. Okay, perfect. Next question up here, we have from Sat10, we got from Discord. "In the starter plan, how many TradingView charts can one use? Each chart sends buy and sell signals. Does each chart count as a unique strategy?"
Yeah, so I thought this question was interesting because I think it is important to sort of decouple the way TradingView's plan and number of charts on their screen relates to how Traders Post works. The strategy on Traders Post side can include signals that come from multiple charts on TradingView. For example, if you're effectively sending the same types of buy and sell signals from multiple charts on multiple symbols, you could send all of that to one strategy and one broker connection in theory. But the number of strategies that you have available to you, of course, are based on the plan that you choose with us. And the real reason to choose another type of strategy is that the trades need to be executed in a different type of way. And then once you have that strategy established with the rules for how the trade should be executed, you can connect that to multiple brokers if you wanted to. So in theory, you could have multiple TradingView charts, one strategy, and it connects to two different brokers, and you're trading two accounts at the same time.
That's right. I guess it was the word strategy that might have confused people, because it's the same sort of thing in TradingView, and then they think, okay, well, since we're integrating with TradingView, that it's like a one-for-one. But
yeah, so maybe to clarify that, when we say strategy at Traders Post, we're really referring to the rules for how your order should be executed with the broker that you choose.
That's right. There was an interesting, I didn't pull this up as one of the questions, but there was this interesting bugaboo that happened where someone was asking, if you have two strategies running in Traders Post and you're trading the same ticker at the same broker, will the orders be separate within the account? Will there be any confusion within the execution of the orders?
Yes.
And the answer to that was yeah. Exactly, because the Traders Post is connecting with your broker, and it sees that ticker. It's not separating the idea. It's not storing all the information that happened with one strategy versus another strategy. So if it says sell positions, or make it flat or what have you, well, it'll do that for the entire that entire ticker.
That's right. So with that broker, a single ticker is considered a position. And so if you send a signal to buy one share of Microsoft, and then in a separate signal you send a signal to buy another share of Microsoft, you now have a position of two shares. So if you send an exit signal, it's gonna sell both shares.
Exactly. All right. Over here, we have this question that came in, which is similar to something we've touched on in the past, but this is phrased a little bit differently. And this is BEK from Discord asking, if I entered a market order, but I have a limit take profit set to a specific number of ticks, I'm seeing that my limit take profit isn't accurate as it seems to vary depending on how the market order is filled. Yeah, so this is an important thing to keep in mind when you're setting any type of order over.
Yeah, so this fits, squarely into the realm of accounting for slippage in your trading. So what we're kind of reading here is that the market order that you have executed in the simulation in TradingView shows that basically you got the exact price you were hoping for. The moment that the signal occurred, you entered the position, you got the exact price you were hoping for. And you immediately sent a signal to set your take profit from your assumed entry price. But when you sent the signal to Traders Post and we sent the signal to your broker to execute the trade, you may not actually get the entry price you were hoping for. And that's where slippage comes into play. The market price may have varied slightly. You may not get, the exact penny that you're hoping for. Perhaps you get a little bit worse or a little bit better of a position than you were hoping for. But if you're basing your take profit on the assumed price from your TradingView entry, then the take profit level might be slightly different than what you expect.
I cannot tell you the amount of hours I've had arguing with clients over this issue. They go, "Look, you must have programmed it wrong because my backtested strategy says I should make this amount of profit." And I'll go, "Look, I totally get that, and it's I get the sentiment there, but you don't know how the orders are gonna run at when they finally get executed." And they go, "Okay, fine, I can accept." People will hear that and accept a certain number of certain amount of slippage, but they don't think it could drastically change the results that they have in their strategy. And it could, depending on what you're doing and how frequently you're trading.
Sure. Yeah.
Um,
The tighter your stops are, the more likely it is that that'll become a losing strategy.
that's right. So I'll have people who will try to get in, and they'll be like, I had someone the other day. They're doing 20 to 40 trades per day,
Mm.
right, on an asset. And so they go, well, how come the numbers are not right? I mean, if margin of error multiplied by the number of trades, you're going to have some problems. And that's if you're setting limit orders, and all of a sudden now there's a discrepancy because your strategy on whatever platform you're using says you're entered into position, but it didn't actually get filled at your broker. Well, now you can't resolve those two things. And so these are all things you have to keep in mind when you're developing an automated strategy.
Agreed. Agreed. Now, normally you could incorporate a slippage rule into your strategy, but I think in this particular user's case, that would change their market entry, and their take profit would still be adjusted based on that market entry. So maybe one other potential solution here is to rely on some of the ways in which we can manage take profits for you at Traders Post, where once your entry is filled, we're basing your take profit off of the mid price of the bid ask spread, which should be a fairly a little bit more accurate of a reflection of what your actual entry price is. And in the future, we're hoping to improve that functionality to grab the actual average entry price from your position and then base your take profit from there. So that way, the execution of the trade is complete. We know what your price was, and then we base your take profit or stop loss off of that. So it's an improvement in the future. In the meantime, using the midpoint of the bid ask is how we determine your take profit, and that could potentially improve a little bit of that trade expression than the way it's occurring from TradingView.
I'm curious. Have you ever seen anything like where people will send, because the alternative to this is that you send a market order, and then that way you have an expectation that you're going to get filled. You just don't know what price you're going to get filled at. Do people ever send, let's say, 3 or 4 limit orders at the same time? Just to at different tick values, and then that way, one of them will get filled, and then they'll know they're in the position, but they know that they're going to be within a certain window. Does that ever happen, or am I thinking about this completely wrong?
Not that I've seen. I have a strategy that does that, but the entries are way away from each other. So basically, I set a bunch of entry orders all at once, but they're at different standard deviations of price. So in the event that there's a shock sell-off, I'm hoping to grab all of those entries.
I
Um,
see.
other than that, that's the only like version I've seen where multiple limit orders need to be set at the same time.
So it wouldn't be like one cancels all sort of thing, and one of the orders gets filled, and then okay, fine, then it counts as the position. Because I had this
Yeah.
one client who was asking like they wanted to have a in these waterfall scenarios where some big candle shows up, they don't want to exit on a market order because then they get filled at whatever price. They wanted me to have it so that let's say it's a 10-minute candle. They want a few limit orders at a time being fired, and then if then a safety order, a safety market order afterwards. Let's say the candle close, so that if they didn't get out, then it would get out at the last one. And I thought maybe I convinced them maybe build a strategy in such a way that you're not like depending on this magic thing from working.
Yeah.
But I think at the back of my mind, I just didn't want to like test that again and again and again. It seems like a nightmare to try to figure out.
Yeah, that's a tough one. I mean, as we just discussed, the variability of each of those entries could change enough that your final trade and average entry price could be way off from what you expect it to be.
Yeah,
Unless this is like, you're trying to accumulate in some kind of consolidation zone and you expect to hold for a while. In which case it just feels like, why not just send, a single limit order or a single market order, in that zone, somewhere within that range that it's more likely to actually execute.
that's right. All right. Perfect. All right. So last up here, I wanted to touch on something. So people have been using the new Confluence Alerts indicator that we publish for traders posts on TradingView, which just as a reminder allows people to basically aggregate certain conditions together, so that if 2, 3, 4 different conditions are true with different indicators, it can then send a signal out through the webhook in TradingView. There was an issue though that I guess it just needs to be made clear here that not all types of indicators can be used with the Confluence alerts. Let me just share my chart here to make it a little bit clearer. So, for example, here, if we have the Confluence of alerts indicator on the chart, and in here it is taking one of four, up to 4 different conditions in order to take a trade. And so if I were to use, let's say, a moving average, here we have the 200 EMA, then when we're inside the Confluence of alerts, we'll be able to choose that source. That indicator will show up here as one of the source options, which makes sense because it's plotted on the screen. But then if you have something like, let's say if you're using the Luxalgo Smart Money concept script, and you're looking to, when there's a break of market structure or an order block or what have you, you might be used to using the alert system to be able to target one of those particular conditions, when a fair value gap gets created, when there's a breakout. But these alerts are not available inside of the Confluence of alerts. It's not available here because those are already conditions that are true, that the alert is then taken into consideration. Or in another way of saying, there's no data on the chart, even though we see drawings here, there's no plot on the chart that the Confluence of alerts can grab. And
So,
so this is just yeah, go ahead.
sorry, Tom, to interrupt. One way I think you can confirm this is to head to the data window on the right-hand side and
That's
see
right.
what outputs come from your indicator. So on the smart money concepts, it looks like they have a number of prices available that show up from their indicator, but not necessarily those exact alert conditions that can be mapped over to the Confluence of alerts.
That's right. Whereas EMA over here does have a value that you can then trigger.
Exactly.
So this is just a limitation with the platform, and an understandable one. You can imagine how it can be pretty confusing to program an indicator that can take all those into consideration. One thing I did mention to one of our clients was that there are scripts that if you're used to using them and you want to use them, and the code is open source, you can make small modifications to the script to then go ahead and make that condition available to you. So it is possible to modify the Smart Money Concepts script to have a plot that goes from 0 to 1, true or false, that you can then tie into the Confluence of alerts. But it requires some programming knowledge in order to do that. You can either hire someone or do it yourself. It's not super complicated. And I might even create a YouTube video for it for our channel just to showcase that, because we did that for one of our clients. But out of the box, you don't be surprised if you're not seeing within the drop down every option, every combination possible. All right. So the last thing I wanted to talk about here. So that's the end of the Q&A that we have for this Friday. Just a reminder to everybody: you can always post your questions in Discord, on Twitter, send us an email, reach out to us however you want, and obviously we'll answer you live. Then we won't necessarily wait for the live stream in order to do it. But we will share the information if it's we think it's useful to everybody. We'll let them know what the issues, what the solutions are. Let me just check the. Yeah, so we have no questions here. So, but you can also come on the live stream.
Sorry, Tom. I did want to provide one update just for any existing Traders Post users. We did send out an email, but we do want to clarify that this Saturday, tomorrow, April 6th, from 1 Central to 2 Central, there will be a small outage for Traders Post as we do some system upgrades. So just in case anybody's doing any crypto trading or trying to send some test alerts, they may run into a couple struggles there from that small window of time.
Perfect. Okay, good to know. All right, sir. So I wanted to touch on this idea of volatility, because we mentioned this at the beginning of today's stream, that price and volume are two of the metrics to pay attention to, or that can be paid attention to in order to make your entries better. But I'm always very surprised by how much volatility is not really mentioned as much. There's plenty of chart patterns, and if you want to have wedges and harmonic patterns, you can get that. You need Bollinger Bands, RSIs, you got that. You need MACDs, you have it. And for volume, people will take a look at volume trends. They'll take a look at the size of the candle for convictions and stuff like that. And there's all kinds of tools that are created for it, on balance volume and that sort of thing. But when it comes to volatility, and you can correct me if I'm wrong, generally speaking, I'm seeing people only really focused on historical volatility or realized volatility, right? They'll use something like average true range. They'll look at something like the Bollinger Bands, Keltner channels, and they'll look at volatility that is either happening right now with the price or in the past. But they don't really look at implied volatility of the future. First, I'll just ask you, Mike, do you spend as much time looking at implied volatility as you do other metrics when you're trading?
A little bit. I mean, it's not. I do look at historical volatility or standard deviation of price on certain futures contracts as part of how I adjust my range of entries and how much I'll scale into positions. But beyond that, the futures market kind of tells a different volatility story. We have effectively open interest we can rely on, which gives some sentiment of how much traders are willing to hold open positions overnight. And then we have the forward curve, which gives us a sense of whether or not long-term there's a bearish or bullish sentiment. If the forward curve is upward and in contango, then I think we have more of a bullish sentiment. If it's in backwardation, where the future price of a much more longer dated contract is well below the current contract, then we're in backwardation. So I think those forward curves are useful. They do tell a little bit of the story. Exactly, right there, Tom. Right now I think there's a fairly bullish forward curve, and we're seeing that show up, of course, in the markets. We're on this continuation of this trend, and it looks like we may have found support at the bottom of this linear trend. But the measure of volatility would really, in futures contracts at least, have to be realized in historical volatility, where we're just measuring deviations of price. The conversations we've had around using the options market as another source of market sentiment, I think, is useful. If you're trading NQ contracts quite a bit, then you can look to the QQQ options chain as a sense of implied volatility for a sense of the market sentiment about the future of the NASDAQ.
Yeah, so just in case anybody, we didn't find it at the beginning, right? When we're dealing with volatility, where in one sense, It's the range of possible outcomes or expected outcomes for an asset. Or in other words, the way I think about it, it's just uncertainty. How uncertain are we about the possible price that the asset might be in 30 days, in a year, what have you? And so there's all kinds of relationships that you can have between all these different volatility measures, right? You could compare the realized volatility that's happening right now over the last 30 days with the volatility that's been over the last year or the history of the asset to let you know if the moves that you're seeing right now are statistically significant compared to what it's been in the past, to let you know, oh, might be something that I should pay attention to. But I just wanted to bring up basically barchart.com here as an example, as a site that you can go to in order just to take a peek if you want to dip your toes into the volatility or implied volatility space. So over here, if you on barchart.com, if you go to options and then to IV rank and IV percentile, you'll get a list of stock tickers and ETFs and indexes, and it'll give you an idea here of what the implied volatility is for the next 30 days. And so just like to be able to let people know that basically what this number is telling you is that the markets are pricing in a 68% probability that the price will move by this amount over the next year. That's essentially what it's saying. Saying there's a 2 out of 3 chances that the price moves up or down, for example, here, Tesla, 55% over the next year, which is super useful to know because sometimes the price of the chart is pretty flat. Maybe it's not moving much, but all of a sudden you're paying attention to implied volatility, and the volatility in the future is increasing. And then if that happens over a number of assets or what have you, you might be able to look at that and go, hey, I wonder if there's larger money players out there or people playing in the future who are seeing something that I'm not seeing now, right? I was taking a look at this last night, which was the Tilray Brands. And Tilray Brands here is sitting at an implied volatility of 144, right? And so if there's an expectation that within 1 year, the asset might move up or down by more than 100%, then that means, well, bankruptcy might be on the table, or some good news might happen in the future that makes the stock go from $2.50 to $5, which might be an interesting play for somebody who wants to develop strategies around that. So I always find that very interesting.
Right. Yeah. Maybe another thing to take a look at too, and I think Barchart probably has this somewhere in baked in, but there's another website called Market Chameleon that provides the premium between implied and historical volatility. And maybe another thing to really consider here, to play a devil's advocate a little bit, is this idea that sometimes implied volatility can be overhyped or effectively overbought, where there's this big premium between IV and HV. And I think institutions even take advantage of that fact. Oftentimes, if the premium is too high between the two, they're selling puts to as many people as possible, because they're going to make a lot of income off of those contracts. And I think Barclays actually released a report somewhere back in 2020 that I could probably find and add to the show notes here, that explained an entire strategy that exploited this sort of retail bonanza on options contracts that created this huge premium and implied volatility. So they were looking for and screening for stocks that had this big premium. So it's fair to say too that while the data is there, it's not always 100% concrete or useful. It can also imply another mispricing in the market or inefficiency in the market that's worth analyzing.
That's true, and it is useful because some people will buy options regardless, right? So regardless of the IV environment, they'll buy options, and they might not be realizing that they're paying a hefty premium for that option. Versus if they waited for that implied volatility to bleed out. And so I know I fall into that trap. I'll be like, okay, well, I think the market's going to move up. Let me just buy the option now. And it turns out, well, if I bought it on Wednesday, it would have been better than I bought it on Tuesday, because I'm not paying attention to how the volatility is moving. I found myself in situations where I'm paying 5-10 times more for a contract, and they go, hey, what's going on? I'm just used to pressing the button, which is not the right way to go. I know that, and we'll end on this here, that in in TradingView and or whatever solutions you're using, you might not have IV, readily accessible to you with some indicator, what have you. But you can. I've built strategies. You can build tools that allow you, at the beginning of the day, to enter in the implied volatility, and then that way you can take that into consideration for the next period of time. And so, even though it's not necessarily, you might not find an indicator out of the box that's already calculating all this for you. It is possible to incorporate this information into an automated strategy, just by being a little bit more creative in some of the code that can be used, either coding yourself or hiring someone like me to do it.
I do think that there's two things to add to that here. One is that there is a hint that maybe TradingView will be incorporating options into their platform soon. We've taken a peek at that. We've seen that the Indian market is now incorporated with options contracts in their interface. You can find the symbols there. The options symbol is in the list, and the options price is in the history, as well as volume. So in theory, you've got all the variables you need to actually price these options and determine implied volatility from this data. So assuming that something like this is going to be available in US markets in the future, we could be in a position where TradingView strategies can be built off of this options data. The next thing I want to discuss is internally at Traders Post, we're planning quite a bit around more options support, incorporating filters for the Greeks, incorporating a measure of implied volatility. And so there could be some opportunity here in the coming months, potentially in 2025, where you're assembling a strategy that relies on some of these rules and relies on some of these indicators that we've been talking about.
So exciting. So exciting. All right. Because even if you're not trading options, that data can be very useful for other strategies. All right. So, Mike, we'll leave it there for this week. It's always a pleasure to speak with you. And we'll be back next Friday with more questions. As always, we want to be the best automated trading platform for you and your needs. And we're always looking for your feedback in order to make the product better. So thank you very much for participating, and we'll see you next week.
Thanks, Tom. Happy Friday.